Hello everyone, it's Professor Reiko here again, and this is our last video from the investment chapter. So we're going to talk a little bit about impairment of value here. So we've already gone through all of our debt securities, our different way to account for our equity investments, and now we're going to talk a little bit about impairment. All right, so just defining impairment is the loss of value that is considered other than temporary or permanent. So if you think about it, we, for certain investments available for sale and trading debt securities, and then our fair value method on the equity securities, we accounted for the change in value using our unrealized gain or loss, accounts. Now what we're saying is this change in value that we were accounting for is something that's permanent, meaning something has happened where it is not going to come back up in value. Okay, so there's different ways to classify to account for it depending on the security. All right, so let's start here. For debt investments reported at amortized cost and classified as held to maturity, you write down the investment to the new cost basis and recognize a realized loss. All right, so write down the investment to the new cost basis and record a realized loss. All right, so you think about if the investment account is an asset, it's a debit account. So writing it down just means reducing it. That's going to be a credit, and then we know that losses are debit. So let's do a quick example here. We've got a company that holds some held to maturity debt securities. The amortized cost is 100, the fair value is 75, and is now determined that 25 is uncollectible. Okay, so prepare the entry to record the impairment. So we would just have a debit to loss on impairment for 25,000, and then we write down our debt investment to 25,000. So you think about it, that debt investment just went from 100 down 25,000, so it's now at 75,000, which is the fair value, the new value. Okay, and so what we did, that sentence right there is this journal entry right here. All right, if they're classified as available for sale, an allowance method is used. Okay, so it's a little bit different, and some of the accounting on this is evolving, and I think there's might be some more changes coming up, so we might have to update this video. But if the fair value is greater than amortized cost, okay, no expected credit loss is recognized. All right, so if it's greater than amortized cost, that's that's viewed as a good thing. Impairment losses are recorded, all right, at the lower of the difference between the fair value and the amortized cost or the expected credit loss. All right, so our journal entry for this will look like this. We'll still have a loss on impairment. All right, we don't have any numbers here, so I'll just put a couple of X's there. All right, and now we have a new account, allowance for impaired debt investments. All right, and so that would be my journal entry. Now, this stuff can get more complicated when we start getting into all these credit losses and things like that. So, just make sure I typically cover this on a fairly high level just to kind of make students aware of it. If your teacher gets into a lot more detail with this, then you're going to have to do the same. So just be prepared for that if that does happen. All right. So the allowance is used to adjust the available for sale debt security on the balance sheet. Okay, if the credit situation reverses, the allowance can be reduced or removed. Okay, so that's something to keep in mind. But the reversal cannot increase the carrying value of debt investment to an amount greater than the amortized cost that would have been existed if the impairment did not occur. Meaning if we had just kept on going, keeping up with the amortized cost. Now remember, amortized cost is that far right hand of our amortization table. So that's what that is talking about there. All right, there is no impairment for investments valued at fair value. All right, where the unrealized gains and losses are accounted for in income, and those are our debt investments that were classified as trading securities. All of our unrealized gains and losses went to net income, and then our passive equity methods. Remember, we did the fair value method accounting for those. All right, so this concludes our chapter on investments. So I hope these videos have been helpful to you. Hopefully they help you prepare for your exams and are just prove as a good supplement to what you're already getting in the classroom. All right, so I hope you're enjoying, and please tune into the next chapter that you're interested in, and keep referring people and letting them know if these videos are helping you. I appreciate it. Take care.